Welcome back to another episode of the Lender Podcast. My name is Bryce, and today we have a special guest speaker on the podcast, Mr. Kevin Green. Thanks so much for being here.
Yeah, excited to be here. Thanks for inviting me on.
You bet. Yeah. So we're just super quick for the audience. So Kevin and I we connected over LinkedIn, and Kevin's got some experience in the field. So we're excited to kind of pick his brain and see how he does things. And sounds like Kevin, you've been lending for about 16 years, which is longer than I think I've been out of high school. So I won't date you, but interesting. So we've got some fun stuff to jump into. So first and foremost, Kevin, go ahead and give us like your high level introduction, elevator pitch. Just tell us about yourself, and then we'll jump into some questions.
Yeah, Kevin Green. Actually been in the business since 1998. Used to be a broker when I first started. I thought that was the pathway, and segued through early part of my career, specifically into private money and hard money. I found it interesting, and that's kind of where we are today. So 16 years, and specifically private money, hard money. Born and raised in California, in Silicon Valley. Grew up in a real estate family. Been spoon fed this stuff since I was a kid, actually, for real estate. I mean, every single night at dinner, my mom's 84 years old, still selling real estate in Silicon Valley, which is
you're kidding,
right? But,
oh, wow.
No, and loves it, and is a wealth of knowledge, actually, for the whole, the whole industry. I think she's just how she's done things. So, went to college, kind of ski bummed around a little bit, and then moved back to the Bay Area, San Francisco, and then that's where I really started my career in real estate. And and here we are. So that's the low level. That's the low level. Worked specifically for a private money lender in the Bay Area. I take that back. Started with the company in San Francisco. That's specifically private money, but only in the city. Really, they're really good with San Francisco. 2010 hit, things got difficult, got out of the business a little bit, got back in, then started working for a company north of San Francisco, and was there for 11, 12 years, and then just kind of broke off onto our own as the market kind of changed. There's some internal things that weren't working for us, and so Matt Cordes, who's our founder, said, "Hey, we need to do this ourselves." I said, "I agree," and so here we are. Yeah, Riker Capital is our company. So.
Wow. Okay. So, I mean, 2008 is a very interesting time to get into hard money. Tell me, and again, I won't tease you too much because I graduated in 2010. So
Okay.
I realize I'm new to the scene, but that has got to have been very interesting getting into lending, when the world was just falling apart around you. What was that like?
Yeah, it was interesting. It was interesting because I was brokering, and I was like, I don't want to broker anymore. It wasn't challenging to me. There was no original thought process. You were just a slave. You were a slave to institutional. They call it subprime. They call it A paper. Now it's non-QM. You are a slave to that matrix or that. What they want, right? So there was no creativity. So I was doing some hard money, and then I got the job offer and said, "Hey, do you want to come work for us?" And concurrently, the market was melting, but you didn't think the market was melting. Everything was fine, right? Everyone's like, Bear Stearns is fine. Lehman Brothers is fine. Nothing to panic about. And then the wheels fell off, right?
Right.
And yeah, it was difficult for sure. I don't think I would take that back, though, because you have to go through those kind of speed bumps and challenges to learn, grow, learn about the industry, kind of see what happened. And then when things started getting, kind of picking back up again, don't repeat those same mistakes, right? As either a lender, an investor, a whomever it is within the industry, don't repeat those same mistakes. And so, yeah, it was difficult, but it was a good learning experience. And was it hard or did it suck? Yeah, it was hard, but you learn, you grow. I look back on it, I'm like, wow, I wish I bought more houses then, right?
Right. Of course.
Nobody knew. right? Nobody knew. So yeah, it was difficult, but a good learning experience, and it kind of helped form who, how I lend and how I think and how, we approach our investors and say, hey, we've seen this before. Matt, our founder as well, is like, we've seen it. We've been through it. There's a lot of people who've not been through it, because we're in a pretty good real estate cycle right now. And so
Right.
we take those experiences and we can bring them to the table and be like, I don't like this loan, or I don't think this is a good borrower, or this is too much risk. And we don't get caught up in it. So
Good. Okay.
yeah.
So knowing that and being through a down market and a down real estate cycle, are
Mhm.
you guys doing anything like specific or special in this day and age to maybe like insulate or pad your business just in case, or is it kind of like business as usual?
Yeah, we do a lot of things actually. I mean, there's a lot when we look at a loan. We underwrite specifically worst case scenario, right? We're seeing a lot of this high leverage rehab loans, 85%, 90%,
Right.
things. We don't play in that world. We think there's too much risk for our investors, and so there's certain segments of the market where we're like, we don't want anything to do with it right now. The high level rehab stuff, not what we do. Office, we're staying away from office unless it's a really good credit tenant, or I like medical office when it's full of doctors, but just normal office, very, very few transactions. So we, there's certain segments where, we're not so, I guess, cheery on. And we don't, the other thing that with our company, we don't get caught up with what other people are doing. We'll look at
Mm,
each loan case by case, its merits, I guess, dismerits, and we'll say, hey, this is a good transaction. And there's, things that go into underwriting, but we can look at our competitor, like, oh, well, so-and-so said they're going to do that deal. Like, let them do that deal because we don't want a problem. Right. So
yeah.
never, yeah, I don't think there's ever a status quo in this business because it's constantly, it's like water. It's always moving. There's always something happening. Um, and so we're very cautious on what we want to do because we are not in the business of owning properties and we are not in the business of fixing major problems, right? We don't want to do
Mm,
that. We want our investors
right.
to be happy. We want our borrowers to be happy. We want the brokers to be happy and smooth transactions. So, um,
Mm.
kind of the short answer,
That's
but yeah, no status
it's
quo for us. Yeah.
okay. Okay. No,
Yeah.
I was going to say that's a very good tip in the sense that I think all too often, just not so much just even in lending, but just business in general, it's very easy to
Mm-hmm.
look at your competitors and like kind of peek up and see what everybody else is doing. Like, oh, we should go do that, or we should do that as well. But um, that may not necessarily be a bad strategy, just to keep your head down and just like, this is our silo, this is what we stay in, and this is the only thing we do. And if you're outside of that bucket, it's okay. We're not for you, but we're not trying to
Yeah,
cater to everybody.
exactly. And you can't cater to everybody. And yeah, it's like we have a box. It's not a firm box where it's like, hey, you have to be in this box, but we just have a idea and a strategy of kind of what we want to fund and what our investors want us to fund and what we present to them. Um, and if it's outside the box, it's okay, right? It's just like, hey, sorry guys, can't help you, and then go on to the next transaction. You know,
I love it.
so
I love
yeah.
it. Okay. Are you, and if you're not, it's okay, but are you comfortable sharing like details of the company, like loan volume, like origination sizes, like any stuff like that?
Yeah, for sure. Loan volume's definitely been down the past 18 months for sure. Previously Matt and I were probably, I don't know what his numbers are, but he's done some very large loans. But I was probably 25 to 30 million a year on average, if not higher in the really good years. Now, in this 2024, you could probably cut that down by 50%.
Oh, wow.
Just because it's the the transaction. I'm in California, right? That's where most land. Transaction volume just has not been there. With rates were at 7.5%, 8%. Commercial market was a little sideways, so volumes down. It seems to be picking back up. I think we've hit bottom. Hopefully 2025, we'll be back in that 30 million range, or me personally, 30 million. But yeah, we'll see what happens, right? We'll see what happens.
I love it.
Loan sizes, 500,000 to 2 million is kind of our sweet spot, our bread and butter.
Okay, your bread and butter. Okay,
our bread and butter is 500,000 to 2 million. Below 500,000, yeah, we'll do those loans. But I really want to be in that 500 to 2 million range. That seems to be where we excel. In what we've seen, what's interesting, previously, 2 million, 3 million, 4 million, 5 million, 6 million, no problems, right? A lot of investors with a lot of capital ready to write a check. And now everyone's pulled back. They don't want that kind of money, or our investors don't want that much money into one transaction or one property, right? So the smaller loans, which is a little weird, are the ones getting funded right now. The larger, more complicated transactions, the debt funds are handling those. But for us, we work with smaller investors. It's like, yeah, I'm not that comfortable with this, but I'm comfortable with that, 16-unit apartment building at a 50% LTV with, good debt service, good borrower. So that's where we are today, right? Next year, if you ask me the same question a year from now, I'm sure the answer is going to be different.
Be very different. Okay.
Be very different. This has been a weird market, right? We haven't seen this. Inflation, rates. You've got a commercial debt coming due. The office building fiasco. So we haven't seen this. So taking a step back, looking at and going, okay, where are the good loans for our investors? Where we feel safe? And then we look at 10 deals, might fund one, might be 20, might fund one. So it's been interesting for sure.
Very unique. Very unique.
Very
I love
unique
it.
market.
Okay.
Yeah. Very unique.
Tell me, elaborate a little bit more on like your investor makeup. Like, so it sounds like you're doing kind of like a direct placement or like syndication type structure as opposed to a fund. Like, do you have 50 investors? Are these just like friends and family, small mom and pop stuff? Like what's your capital stack made out of?
Yeah, okay. All the above. So friends and family, previous people we've worked with, people who actually just have gotten our name through word of mouth. Just like, hey, we did this deal, it paid off. These guys are great. Phone will ring, and then we put them into our investor database. It's funny. Everybody I talk to in this business, you can have a database of 500 investors. You seem to work with, 20 to 30 consistently, right? They trust you. We trust them. They know the process. So yeah, probably over, or close to 100 in our, investor database, but really 20 of them who we really like and enjoy working with on a consistent basis. And there's a good kind of, mutually beneficial business relationship that's happening where we present them good loans, no problems. They pay off. They're like, hey, that was great. Let's do another one.
Let's do it again.
The issue we've seen, and I don't know if, if you guys have seen on your side, is when people are getting a money market or CD at 5.5% with no risk, right? They're like, well, why would I want a 9 or 10% yield in real estate right now? I can get I could get a treasury. And so that will change, I think, as rates come down, where people are like, hey, I need to get yield again. But for the past, 18 to 24 months, give or take, it's like, yeah, I don't want any risk right now because I can get this yield on a treasury or a CD or money market, whatever it is. So
that's a very interesting point.
Yeah, that should.
Wow. Okay.
Yep.
So it sounds to me like you have, so you have your borrowers, you have a loan that comes into your pipeline, and then you obviously underwrite and vet that deal. And then from there you kind of farm it out and say, hey, we've got this loan pending. Who wants to invest in it? Is that how it works?
Exactly. So we'll do a pre-underwrite. Either myself will underwrite it, Matt will underwrite it, or underwrite it together a lot of the times if it's a little bit tricky. And kind of say, okay, what do you think? And almost like a mini capital committee, where if I say, oh, I don't know, or if he says to me, he's like, I don't know, then we're like, maybe this isn't the right transaction. So we'll do the pre-underwrite. We'll vet it and present it to our investors and say, hey, here's the transaction. This is the yield to you. This is the story. This is the exit strategy. And here's the amount needed, and here's location. Sometimes we do appraisals, sometimes we don't, depending on what the situation is. It's wild the accuracy some of these AVM models can get us. I mean, the technology is really good, especially if it's a purchase versus a refi. So we vet it, we put it out to our investor database. They commit, based on a percentage. Sometimes they want the whole thing, and that's usually how we work. You mentioned it's interesting. We're going to do a fund, but we feel as this time right now is not the best time to go out and raise capital, just for the sense that interest rates are where they are, and again, people can get yield, low risk yield. When rates start coming back down and the spread changes, then we'll probably do a fund as well. But right now we're just, we syndicate to our investors. So yeah, it works.
Because that was a good model. That was going to be my next question for you, is why, if there was like a specific reason why you hadn't done the fund, if it was like strategic or just not interested, or it just didn't fit your business model. But that sounds like that's a good.
Definitely interested, but it's right now. I think the timing and I've got a lot of coworkers, friends in the industry. I'd call them friendly competitors, or just people we've done business with over the years, who we really, really like and talk to on a weekly basis. And a lot of them are saying, like, we are having a very difficult time raising capital right now. And I'm like, interesting. Okay, well, maybe, we've talked about it. It's like, we're going to do it, but now is probably not the best time to do it. Things are in motion in that sense, but it's not like priority right now. We have to go out and raise
right
capital.
this second. Absolutely.
I feel like capital right now is not the issue. There's always money, right? You can always find the money. It's the quality deal flow that is the issue, right? For me or other people, just not looking at junk and saying, hey, this is a very good transaction. Yes, I will put my own money into it. I invest a lot in my own trust deeds, because if I'm going to put my money in, I would, my investors say, hey, Kevin's putting money in, that means he believes in the deal. And I usually do, right? Say, hey, I'm going to go in for X amount. And then it's interesting, when I got in the business, one of the things that will always stick with me is somebody told me, they said, if you're not willing to put your parents, grandparents, or uncle or nieces, nephews, college funds into this transaction, that's how to think of it. If you would not put their money into it, don't do the transaction. And that's always stuck with me, because I'm like, why would I want to? It's like, I want to believe in the transaction. If I won't put my parents' money into it, or my niece and nephew's money into it, I'm not going to ask somebody else to put their money into it. It's not.
Absolutely.
It's not. Yeah. That's always stuck with me for whatever reason. I don't know why.
I love that. It's interesting because, likewise, we invest in a lot of our own deals as well. And the funny thing is, I'm more comfortable losing my own money. Luckily, we've been fortunate where that hasn't been the case, but I'm infinitely more comfortable losing my own money than my parents' or aunts' or uncles' funds. Like, I would have a horrible time going to them and be like, well, shit, we lost your money. I'm really sorry about that. So that's a very good, a very good rule to go by. And for kind of the same token, I once heard something similar. Those people who like you can just describe as like an animal. Like you just like I know some people out there who are just like, they're just animals. Like they're very creative. They're hungry. They just they're doing big things, and those are the kinds of borrowers that I love that I know I'm 100% confident. If I can say, yeah, he's an animal. Like, I have no problem whatsoever, funding his deals as a borrower, because I know he's going to perform, and he's that kind of an individual. But if there's somebody who's kind of wishy-washy, like, like they can't even handle their own personal finances, what makes me think that they're going to handle their business finances, my business finances. That's
Mm-hmm.
kind of been a safety check that we've used to like, maybe we'll pass on this one.
Yeah, no, for sure. Yeah, it's a funny business. It really is. I mean,
It is.
it's changed, in the sense where you have large institutional capital flowing into our business. And they're saying, hey, we're private money. Like, you see it all the time. They're massive.
Mm-hmm.
They have a matrix. They have sales reps. Like, we're a private money lender. And I just laugh. I'm like, you're not a private money
No, you're
lender.
not.
You're an institutional backed company saying that you're private money.
Right.
And I'm just like, this is not private money. Private money is what you do, what I do. It's almost like a peer to peer, right? Where you're matching two people and saying, here's a borrower, here's an investor, here's us, and let's make something work if there's a transaction here. This whole, we're private money, and like, private money, you just traded a $300 million pool to some guy sitting in a desk in New York. That is not a private money, right?
Not at all.
You're
right.
open to anyone and anything, right? So I think the business is funny in the sense where it's kind of segue from its original kind of origins, right? I mean, I'm sure back in the day in 1860, there was a guy at the saloon who said, oh, Joe wants to buy a piece of land out there for his cattle. And he said, hey, this guy over here's got money to lend. You guys should meet, right? And now I think we've moved into this kind of institutional Wall Street thing, because those guys figured out, like, how are these guys getting such good yield on low LTV assets? We need to get into this game, which is fine, but it's definitely interesting how it's been packaged to the industry,
Yes.
in my opinion. Yeah,
absolutely.
Yeah.
So two questions to kind of piggyback off that. One,
Yeah.
do you, it sounds like I already know the answer, but it sounds like you guys don't incorporate any institutional capital into your lending stack. It's all 100% like private investors.
Correct. We have a couple correspondent relationships for very, very large transactions. You can see on our website, we did a construction loan, 60 million plus, but that's way past our capital stack. So
Wow.
We have some correspondent relationships. Matt is the Houdini of construction loans. That guy knows more about construction than anybody I've ever met. So when we get to that level, we have some relationships. But for, I want to say 90% of our transactions, maybe 95, it's all our small investors, non-Wall Street. Let me take that back. They're institutional investors, but they're not tied to Wall Street, right? High net worth, whether it be whatever industry, software, insurance, real estate, developers. But as far as like selling things to Wall Street or any of that, it's just not our model, not what we do.
Right.
Yeah.
So
thank God.
So no, yeah, right. Absolutely.
Yeah.
So knowing that there is like you said, the money is out there everywhere. There's so much money in the
everywhere.
space.
Yep.
How do you guys personally kind of like separate yourselves from those? Like, what's your unique advantage? How do you separate yourselves from Kiavi or Pure Street or some of these other massive nationwide lenders?
Well, Pure Street had a little bit of problems, but obviously because they're well, I mean, it's you're talking to the decision makers, right? I'll make a decision, very quickly, or if Matt gets the loan, I mean, we can make the decision in speed, in execution, right? We're not dependent on an underwriter. It doesn't have to go through all these channels. So we can do things without an appraisal if it's warranted. And then we can go outside of the box. We do a lot of cross collateral. This year, I've done some really good land loans this year, which is shocking, right? It's like, you did land loans? Now, they're really good locations, right? They're urban infill, but everyone's like, why are you guys doing land loans? I'm like, I don't know, because it's a 30% LTV in a major MSA 5 blocks from the beach, right?
Yeah.
So things like that, where, we can say, yeah, we want that loan. That's a good loan. I will, if something happens, my investor will be happy to own that lot.
To take on that property. Yeah.
Take on that property in a heartbeat. So, that's kind of our unique selling propositions. We can move fast, and I can give you a quick answer based on knowledge, experience, location, all these things that we've just taken our lumps over the years. We know what to look for, not to look for. If it doesn't smell right or it doesn't look right. Where like talking to these Wall Street guys, they hire these reps, and that's fine, and they're young, and a lot of them are kids, and they go out and they just pound the pavement, and they don't have any underwriting authority or funding authority. They're just out marketing, and that's great. But if somebody's in a rush or they have a weird situation, let's say, hey, I need to buy this house, but I own this commercial building. Can we cross collateralize the commercial building with the house? And how do we make this work? We can flow through that very quickly. And it's not like, no, we only lend in this little box. We've done some interesting stuff for sure over the years.
Well, and you're talking to directly to the decision makers, like you said. You're not
Right.
just some random like sales rep. Like we're the one who's directing these funds, and we can say yes or no.
Exactly. We already know, just based on our experience, and then having these relationships with our investors, we know what they want, right? They say, hey, this is what we want, and this is what we're comfortable funding, and what can you just show it to us? So we already know before the deal hits. If I get a call from a broker, said, hey, this is what I got, I know within 30 seconds. I'm like, yeah, it's a good loan on the surface, or it's like, this isn't going to work, right?
Right.
So we can really, really fast, right? And in this, I think in our business, speed is of the essence. A lot of times, I mean, how many times have you gotten a call saying, yeah, the bank said no, we're supposed to close in 3 days, right?
Like every day.
Every day.
Yeah.
Every day. Yep. Every day.
Yeah.
So
absolutely.
I'm like, why didn't you call us a month ago, and we wouldn't be stressing right now?
Right.
Oh, they said they could do it, and my salesperson said they could do it, and then it went up the chain of command, and the VP said they could do it, and it's just like, we hear it constantly, right? Every day.
Right.
So
got it. What's your opinion on the I've talked to some lenders who say loan to own, like, so what if the project doesn't go through and we have to foreclose, like I still want this property. What's your opinion on that? Do you like that model? Would you rather just like, I don't really want to own any of these properties? What's your take?
So we are not a loan to own by any means. Our investors are not loan to own. Being in California, being the funny state that we're in, nothing is easy when it comes to something like that, right? I don't know about other states. I don't know how Idaho is, or Montana, or Texas, but California is not easy, right? So we do not want any problems. But on the flip side, when we underwrite a deal, I'm going to look at it and say, you know what? If this thing goes completely sideways for whatever reason, I'm okay with this thing going to foreclosure. My investor is going to be okay with it going to foreclosure. And I'm confident that this is such a good transaction that it's not going to get to the point where they're going to own it, because somebody's going to buy it at the courthouse steps, right? So always worst case scenario, usually doesn't happen. It didn't happen to me until recently on a couple, which were a little bit out of our control. This is with our previous company. But I mean, it was a grind, right? It was a grind because the borrowers, when they realize they have equity, they will do whatever they can do to try and save that equity, even though they know they're in the wrong, right? There's always seems to be an attorney out there who will say, oh yeah, I'll take this case, right? Knowing that it's not going to go anywhere, but it still costs everybody time and money and headache. And so we try to avoid all that.
Absolutely.
It's funny. I'm sure, as you know, nobody has a problem borrowing the money. It's paying it back where the problem seemed to start, right? Right.
Imagine
Never have anybody say, it's like, I don't want the money. And it's like once in a blue moon, right? But it's when it's like, hey, there's a maturity. What are you going to do? Yeah, I don't know. I have to figure it out. It's like, well, you got to figure out quick, right?
Yeah, you better start working. Yeah.
You better start working on it, right? You better start working on it. So.
Wow.
Do you guys do you run into the loan thing, or is it the same thing with in Idaho, or is it? It's
So we are lucky in the sense, and granted, we are rather new in the space, so we have not yet had any issues with foreclosures. Like our default rate right now is 0%. So
that's great.
um,
Yeah.
I'm I'm not so naive as to think that like it's not going to happen. I know it's a when, not if. I just it's just a nature of the business and one of the
It's
things
yeah.
that we have to handle.
Yeah.
But I am curious what your experience with that was, because where we haven't had to go through that yet. I know it's going to happen. So any like recommendations or tips or anything that you would do differently, knowing what you know now?
You know, on the ones that did go south, I'm trying to think. Like one of them was just, I mean, it was a nightmare. I mean, there was a fire at the property, and I mean, it's like there's nothing we could have done right on that one.
Mm,
And then, and I think a lot of the borrowers panic or they're in a corner. And I think, I mean, I don't know if any borrowers listen to this, but I think the one thing you could do with your private money lender, um, not so much of what I would have changed, but I would, you know, tell any borrower, even the broker who brings you the deal, if there's a problem, it goes a long, long way to pick up the phone, call me, call Matt, and say, hey, we've got an issue here. We need some help, right? Okay, what's the issue? And then we can work through it and we can get our investor involved. Say, okay, how do you want to handle this? What do you want to do? We don't want to get into a situation where everyone's threatening each other. There's lawyers and this. That's not what we want. We want everyone to
right.
work together to come to a really amicable conclusion where everybody's happy and everyone gets paid. And then it's like, hey, thank you very much, and we part ways when the loan's paid off. So
Right.
I think that's the one thing is if the borrower just is open and honest and saying, hey, this is what happened, or when it happens, immediately let us know, right? Versus getting to the very end of the loan and go, oh, by the way, right?
Right.
Um, we just had one that seems to work. We're going to work through it, but the bar was a construction project in San Francisco, beautiful home, and there was a stop work order that was issued on the property. We didn't know that until we've got to maturity, and it's like, hey, why is this thing so far behind? What happened? Well, we go into the public record. There's a stop work order, right? It's like, well, why didn't you tell us there's a stop work order? What happened?
Three
There's
months
something.
ago. Yeah.
Yeah, 3 months ago, right? That would have gone a long way, and we could have worked through this as soon as it happened, right? But and we're working through it. It will be fine. But again, it's like, wow, why didn't you just call us? Like,
Right.
we're not gonna bite.
Yeah.
We're trying.
It's interesting that you say that, because I think borrowers, they've got their tail between their legs, and they're afraid to come to you and say like that something's not working. But the funny thing is, like, more often than not, like, we have been in those situations. Like, so previously, before I was a lender, we did almost 100 fix and flips personally ourselves.
Wow. Okay.
We have had issues with permits and stop construction orders and like all this other stuff that, like,
Yeah.
like, your lender is on your side. He's there to help you. Like, it's a win-win scenario. Like, if you're successful, you're profitable, the lender is profitable, the investors are
That's right.
profitable. Like, it's in everybody's best interest for this loan to perform. So
That's right.
yeah, it's just interesting that borrowers, the natural tendency is like, I'm just going to hide and pretend this thing goes away. But everybody knows it's not going to. It's so funny.
Yeah, it is fun. Exactly. It's like, hey, this problem's it's like a snowball, right? It just will start rolling downhill,
It gets worse
and
and
then
worse.
and it's interesting because we talked about like this high level like ARV stuff, right? That some of these lenders are doing, 85%, 90%. And I see more problems with those loans. And I don't know how these companies are working, these big, big fix and flip companies, how they work through all these. But we see them, I probably see 2 a week right now, 2 a week. We're like, oh, it's 60% done, and they won't give them any more draws. I'm like, red flag, what's going on, right?
Right.
And so I don't know how. I mean, they must have really good workout people because I see them all the time. I'm like, wow, this is scary. And one thing we don't do is we will not rearrange the deck chairs on the Titanic. And by that, I mean, we are not going to inherit somebody else's problem. We don't do, bail, like we'll look at maturity defaults. Things happen if the property's fine or whatever, we'll look at those. But, half completed construction or, non-pay or slow pay. And they're like, oh, the lender wants their money back. And, we never want to be the last one in. That's for sure. So we don't do a bunch of the bailout stuff. And it's a simple business, and those things are complicated, and we don't want any complications. Our investors don't want it. We don't want it, so.
Yeah, it's a very simple business model as long as everything goes according to plan. And most of the time it does. 99% of the time it does, but
exactly.
there's still that edge case there.
If you do your job and I do my job, right? If we do our jobs the way we're supposed to and underwrite correctly, 95, 97, 98% of the time there's no problems, right? It's that 1%, and we don't want to deal with those. It's no thing.
Try to mitigate that as much as possible. Yeah.
Exactly. You can mitigate it pretty. I feel like we can mitigate it pretty well up front. There's always things that kind of happen, but we can underwrite it and go, yeah, this is a good loan. This is a good borrower. This makes sense. And just right off the bat, in 30 minutes, I'm like, yeah, this is good, or man, this isn't going to work.
Not so much. Yeah.
Not so much.
Yeah.
Not so much. So
I wanted to switch gears here for a second and ask you, because you're actually the first lender that I've ever spoken to who lends in or lives in California and lends in California.
Mm-hmm.
Most of the time, people that we speak to are somewhere else in the States, but they don't want to touch California with a 10-foot pole.
Right.
Do you are you familiar with like the rules and the regulations and the different licensing and stuff? What makes lending in California so difficult?
Yeah. Okay. I'll preempt this. I'm not an attorney. I'm not giving legal advice.
Not legal advice. Yeah. Don't sue me, please.
So California is a funny state, and we get a lot of calls from out of state guys who want to do business here. I'm like, okay, well, do you have a, NMLS or CFL or California DRE, whatever? And they're like, no, but it's a commercial loan. California, it doesn't matter, right? If you're trying to broker a loan into California, technically you were supposed to be licensed by the California Department of Real Estate. Nevada's a brick and mortars. Arizona's tough. I think the other really hard one is it's New York. New York is supposed to be a real bear on consumer stuff, not on commercial, I believe. California. So I hold a California broker's license. I originally had a California salesperson's license, which is through the Department of Real Estate. You can get a NMLS license and only have that depending on the institution or banker who you're working for, if that makes sense. So I have a California DRE. Our company has a California corporate DRE. I also hold an NMLS if I ever do consumer loans, which is very seldom now. And so there's different kind of areas where you have to be licensed. There's also one that's called CFL, which is California Finance Lender, which most mortgage banks have. And then there's all these caveats about CFL licensees sending us a loan and we can't pay them a referral fee, or they can't charge points. It's just, just a mess. All sorts of stuff. It's a mess. Yeah, it is a mess. So there's all these different kind of rules and regulations, and it's a little bit of a minefield, to be honest with you. We have some really, really good attorneys who we work with, who are just private money guys. They're awesome. And then we have a couple really good compliance people who pull docs for us. And they really know the inside and outs of the regulations and what we can do and can't do. And I feel like we're pretty good with it. But again, when we have a question, it's very easy to send an email to our attorney and say, hey, can you just help us with this? What do you think?
Just take care of this. Yeah.
Yeah. What do you think? Just give us a quick, what do we need to do? And for $200 or $300, that advice can save us hours and hours and hours of headache, right?
And thousands of dollars.
We have a pretty good handle on most of it, but sometimes our business is so funny that stuff will pop up. We're like, geez, haven't seen that one before. How are we going to do this? Okay, quick email. This is how you do it. This is how you stay compliant. And we're like, okay, sounds good.
Interesting.
Yeah.
Interesting too that even after 20 years, you're still encountering situations and circumstances that you haven't crossed before.
Well, the laws keep. What's crazy? I mean, obviously you're in Idaho. I'm sure you hear all the stories about California, how crazy everybody is here, right?
We do.
Yeah. Sometimes I'm like, God, if it wasn't so beautiful here, I think I'd leave, right? But I love it. I'm born and raised. I've been here my whole life, so I'm not going anywhere. But I'll give you an example. There was a ruling that came out last year. People can look this up. It was the Moon case. And what happened is there was it was a hard money loan that went sideways. And they tried to do an extension. And there was a bankruptcy involved, and it went through the whole system. And the borrower said, "Hey, the extension isn't legal because of usury." This is a short version. I mean, it's a long case law, right?
Okay.
So it went to court, and the court basically said, "If you are not, bear with me here, if you are not the original broker who sold the house to the borrower, that's who has to do the extension, not the lender, not us." We can't do the extension. Legally, they said, you guys cannot do the extension. It has to be the original broker who sold the house to the borrower. Everyone's like, what? What are you talking about? Uh-huh. Yeah, it's the Moon case. You can look it up. So for a while there, unless you had a specific type of license, which is the CFL license, and funded under a CFL, we funded under a DRE, we couldn't do extensions, right? We were like, sorry guys, we either have to rewrite the loan, or finally, now it's on Governor Newsom's desk, where he's going to say, hey, this is wrong. He's going to say, hey, the broker, if there's a broker involved with the extension who did the loan, we can do it. And that's going to kick in January 1st. But for the past, I think it's been 14 or 15 months, extensions basically have been off the table, which is insanity, right? So,
right.
So we're getting the emails from, our council and following the industries, what we do. And we're like, this is wild, right? We can't do an extension on a loan, right? This is insane. So that's working itself out. But just staying on top of those things, yeah, it's the compliance piece is a bear in California. Even on the commercial side, it's like, oh, it's a commercial loan, doesn't matter. It's California, it matters. It's all, and then the Department of Real Estate is they do what they do, but they're a tough organization. Like you want to make sure everything's compliant and you're doing it the right way. And if you're not, and you go through an audit, it's no fun, right? It's no fun. So you have to stay on top of the compliance. You have to stay on top of what the new laws are, even though they're changing. I feel like weekly, literally in the state. It's wild. You have to stay on top of it. So like I said, I feel like we're pretty good at it, but that's why we surround ourselves with people who are really good at it. And if there's ever a question, it's a phone call or email away. And we're always on the side of caution, not like, whatever, it's fine. No way, never, ever, ever. It's always like, we want to make sure that this thing is compliant 100%. Right?
Cross your T's and dot your I's, make sure it's 100%. Yep, rock solid.
100%. Yeah, 100% solid. And then that way we know if anything does happen, worst case scenario, that we're covered, our investors covered, our brokers covered if they did everything right, that there's going to be no problems, right?
I love it.
I can't say it enough. We want to stay away from problems in this business, right?
Yes.
They come up, but they come up, they happen. But the more work we do before the loan is done or signed, the more work we do on that side, the easier it's going to be on the other side if something does go south. And knock on wood, hasn't really happened, here and there, but nothing major. But again, it's almost like, I don't know, it's like football, right? Like these guys practice all summer long and practice and practice and practice before that first snap, right? And then they're ready for whatever happens. And kind of the same thing, like we practice and practice before that loan is signed at the signing table. And we know everything's going to be fine if it goes south, right?
Right.
And it, like, again, it hasn't happened, but it's part of the business. It happens.
Yeah. Nobody wants to fumble that ball, especially if you're
nobody. We
if
don't
you're
want
on
any
the
fumbles,
receiving end.
sacks, fumbles, interceptions. We don't want any of that. So
That's right.
none
I
of
love
that.
it. That's
So,
right. Okay.
yeah.
Well, Kevin, I want to be conscious of your time here. Right? We're coming up almost on an
Yeah.
hour, but I want to last question for you. If you could go back in time, knowing what you know now, starting over from scratch, what's the one tidbit, one piece of advice you would give to your former self, or even to me myself as a new lender? What would you do differently?
I actually probably when I got into it, and it's not just for myself or for you, it's actually for the brokers out there and the borrowers, is know your numbers, right? Know the numbers. If it's a commercial building or a multifamily, know, and I had to learn this myself. I basically, was kind of under the tutelage of some people who really kind of helped me through this when I was just like, didn't really know anything, right? It's like, oh, it's rate and LTV. So I'd say back to my old self or to anybody, know the numbers. If it's a commercial building, what's the NOI, right? What's the rent roll look like? What's the lease rollover look like? For fix and flip, what's the loan to cost, or construction? What's the loan to cost? What's the liquidity of the sponsor? What's their resume? So knowing the story and the numbers has helped me over time really be able to vet a deal very quickly. I didn't know that when I was younger and, just first got in the business. I thought it was rate and LTV, right? So if I wish I had gone back, and said, when I first got in the business, said, hey, let's just look at the numbers, right? Like, what are the numbers? And I think that would have saved me a lot of time, a ton of time. Really,
absolutely.
Really understanding numbers. And now it's pretty easy. But back when I first started, I'm like, what's that mean? Or what's that? Like,
right.
Real estate license. I had no idea about anything, right? It's fresh out of college. Had been skiing for a couple years.
In real estate, there's so many different like acronyms and vernacular, and just it's its own language, and you really do have to be well versed in it.
Yeah, exactly. And I think the other thing too, to kind of segue on that, it's like I work with some really good residential people, and I work with some really good commercial people. I work with very few who are good at both, right? So if I had to go back, for me, I probably would have segued into saying, hey, I would have just gone straight into commercial, right? Commercial lending, as a banker or broker, or sales or something like that. So my original self, I probably would have said, hey, I'm going to go in this direction, be really good at it. But I've never found just a couple guys who can do both. I've found, but for the majority, it's like really good at commercial, really good at residential, not really good in the middle. So I wish I myself had segued probably into the commercial really hard, because my learning curve would have been a lot easier than what it was, getting my butt kicked for years on end, right? Years on end. Yeah. But now we're here. So now it's good now. Everything is fine now. But it's
you made it.
Real estate's strong. I think I made it. I don't know. Hopefully.
I don't know. You seem, right? Yeah, you seem to like, not that our podcast is that prestigious by any means, but you made it. So if that's the pinnacle,
then
I
made it. Yeah. No, it's good. It's this is a great industry. Real estate is awesome. I know the residential realtors probably not having a lot of fun right now with this new commission thing.
Right.
But
all the NAR rules and everything. Yeah.
Yeah. But the beauty of this business is that you can create a very good life for yourself. And then before we got on the podcast, so I just surfed at noon. I surfed from like 11 to 12:30. I'm like, oh, I got a podcast, and came check my email, and you can create this life.
Very cool.
Hey, I'm not chained to this corporate desk. I can create this really good life, be with my family, do really cool things, and make a really good living, and actually help people as well. Right.
Yeah.
And that's, for me, it's like, I don't know what else I would do at this point, because as much as I sometimes grouse and like, oh, this business, and then at the end of the day, I'm like, Yeah, I'm pretty happy. Things are
Yeah.
pretty good, even though the market's not.
What other type of business gives you that flexibility and that lifestyle?
Exactly. It's a good thing, right? It is a good thing for sure. So,
I love it. I love it. Such
Bryce,
good advice.
Where are you guys? Where are you in Idaho?
So we're in Idaho Falls.
Okay, cool.
If you're familiar, it's about 4 hours east of Boise. It's a smaller town, so not super common on the map.
Yeah, it's close to Sun Valley, right?
Yeah, very close. We're about an hour away.
Yeah, I've stayed there. Yeah, I've been through it. I've driven over that bridge. Doesn't everyone base jump off that bridge?
Yeah, that's right.
Been there a bunch.
That's the one. That's the one. Yeah, people
one.
die off that every year.
And I assume that market's probably growing quickly, I would assume right now, huh?
It is. Especially in COVID, Idaho and Utah were some of the. It's something insane. Like I think Idaho was like 23% appreciation year over year. It was either number 1 or number 2 in the nation. It was just absolutely nuts.
Yeah. Yep.
So
got it.
Love it.
Cool.
Love it.
Nice.
Well, Kevin, seriously, what a wealth of information. Thank you so much for your time and your expertise and coming on. Like this has been great. If anybody wants to get a hold of you, what's the best way to do that? I mean, structure.
Yeah. So phone number, you can just call me direct, 415-793-3403, or you can email me, Kevin, Kevin at Ryker, RYKER capital.com. And yeah, just, I like talk to people. So just pick up the phone, call me. Email's not personal sometimes, so yeah, just call me, talk, and see how I can help.
I love it. Yeah. And if we have any California stuff, we're definitely going to be directing it your way because nobody else knows how to handle it. So you might see an influx of business.
It is I would love to look at it. Like I said, it's a challenge compliance wise, but good loan sizes, good value, good property, and a lot of areas in California through this little speed bump have really not slowed down. Maybe a little bit. Right. But, coastal California, Silicon Valley, Bay Area, Sacramento, there's still demand. There's a lot of demand and there's just not enough housing and there's no place,
Absolutely.
There's no place to build. There's no place to build.
So, it's a consistent issue. Yeah.
Yep.
Perfect.
That's a whole nother podcast.
I know that's outside the scope of this, but yeah, we could definitely, we could keep talking for sure.
For sure. Yep.
I love it. So, well, again, Kevin, thank you so much. Listeners, thanks so much for sticking around, and until next week.